In the complex world of finance, central bankers face a daunting challenge, a problem even scarier than what we've seen before. The Federal Reserve, or the Fed, has been raising interest rates rapidly, believing it's the key to combating inflation. However, the real nightmare for central bankers is deflation, and the tools they have in their arsenal seem insufficient to tackle it. The Fed's strategy of raising rates to control inflation might work, but when it comes to deflation, the waters get murky. Traditional tactics like lowering rates or implementing quantitative easing, QE, fall short. QE, in particular, where the Fed buys bonds from banks, doesn't channel money into the broader economy. Instead, it gets stuck in the banks as excess reserves. Now, the question arises, can we venture into negative interest rates? Europe, Switzerland, and Japan have tried, but the results are inconclusive. It's like an experiment that didn't quite work out as expected. This situation exposes a broader challenge in the global economic landscape. The interconnectedness of economies means that the actions of one central bank can send ripples across the world. It's not just a local problem, it's a global concern. As we navigate these economic uncertainties, it becomes crucial to rethink our strategies. The central bankers are in uncharted waters, and the old playbook might not be enough. Perhaps it's time for innovative approaches and adaptive policies to address the intricacies of inflation and deflation on a global scale. The economic landscape is evolving, and it's essential that our understanding and solutions evolve with it. Deflation, an economic menace wherein prices spiral downward, wages stagnate, and consumption falters, poses a formidable challenge for central banks. The conundrum lies in its self-feeding nature, exacerbating economic distress and vexing policymakers. Examining historical instances, particularly the 1930s during the Great Depression, provides illuminating insights into the complexities of battling deflation. In the annals of economic history, the Hoover administration's response to the Great Depression marked a stark chapter. The economic downturn, fueled by a cascade of financial failures, prompted drastic measures. Franklin Roosevelt, upon assuming office in 1933, confronted a similar predicament. In an audacious move, he issued an executive order shuttering all banks, a decisive step to quell the pervasive banking panic. This historical episode prompts contemplation on the hypothetical scenario of a contemporary president, be it Biden, Trump, or any successor, issuing such a sweeping decree, underscoring the gravity of economic crises. Central to the narrative is the Federal Reserve's role during the Great Depression. Despite its mandate to stabilize the economy, the Fed found itself hamstrung, unable to counteract the deflationary spiral. Insights gleaned from a personal conversation with Ben Bernanke, a distinguished authority on the subject, illuminate the challenges central banks face when grappling with deflation. This dialogue underscores the difficulties encountered by institutions tasked with steering economies away from the precipice. A pivotal and unconventional strategy employed by Roosevelt to combat deflation involved the deliberate devaluation of the dollar by raising the price of gold. This unique approach, bordering on insider trading, sought to recalibrate the economic landscape. By increasing the price of gold by a staggering 75%, from $20 to $35 an ounce, Roosevelt aimed to inject vitality into a stagnant economy. The rationale behind choosing gold as a lever for recovery rested on its impact across sectors, influencing prices of commodities like corn, wheat, and steel, thus initiating a domino effect. Remarkably, this strategy bore fruit. The economy experienced a resurgence, with market booms and improved overall performance from 1933 to 1936. The Democratic theme song, "Happy Days Are Here Again," reflected a palpable shift in public sentiment. However, this period of rejuvenation was short-lived. In 1937, the Federal Reserve's interventions precipitated a second recession, perpetuating the economic quagmire, leading to the infamous label, the Great Depression. The historical narrative resounds with contemporary relevance. As the global economic landscape grapples with uncertainties, the specter of deflation looms. Everyday citizens become unwitting casualties as real interest rates soar, intensifying financial burdens. The persistent challenge for central bankers and economists is that, once deflation sets in, conventional tools lose efficacy. The resonance of Roosevelt's unconventional yet successful approach invites reflection, prompting questions about the potential effectiveness of devaluing the dollar against gold in today's extreme circumstances. With global economies poised on the edge, it emphasizes the necessity for nuanced economic strategies, deriving insights from historical wisdom to navigate the intricacies of deflation and stimulate sustainable growth. This rationale for holding gold becomes more apparent as we face an impending global recession, a rare occurrence, unlike the regional economic downturns seen in Germany, Japan, or the US individually. Typically, there is another economy or group that performs reasonably well, helping pull others out of economic stagnation. However, the current trend is a global recession, reminiscent of the 2008 crisis. The United States, Japan, Europe, China, and India are all grappling with economic challenges, often tied to the shortage of dollars. Contrary to the misconception that these countries are abandoning the dollar, the reality is that they are experiencing a shortage of dollars. In response, nations like Switzerland, India, China, and Japan have witnessed declines in their US dollar reserves. This decline does not signal a dislike for the dollar, instead, it reveals a pressing need for dollars. Consequently, these nations are compelled to sell treasuries to acquire the necessary dollars to rescue their struggling banks, unveiling a widespread desperation. The observed decrease in dollar reserves is not indicative of animosity towards the dollar, rather, it underscores a shortage of dollars, driving nations to take desperate measures such as selling treasury securities to salvage their banking systems. This paints a grim picture, suggesting that a global recession is imminent, marking a parallel to the challenging times witnessed in 2008. In the intricate dance of global economies, where communism, socialism, and capitalism coexist within a tangled web of interconnectedness, a singular thread weaves them together, the US dollar. It's not merely a currency, it's a powerhouse, dictating the ebb and flow of international trade. With 60% of global reserves and 80% of global payments denominated in dollars, it stands as the benchmark for every other currency, rendering even diverse economic systems subservient to its influence. This dominance becomes evident when we scrutinize commodities like the euro, gold, and oil. Despite their independent identities, they are quoted and referenced in dollars. The dollar isn't just a currency, it's a gravitational force, pulling disparate economies into a shared orbit. This phenomenon explains the simultaneous unraveling of seemingly unrelated economic systems when faced with global challenges. So, why is this relevant to your investment strategy? Understanding the interconnectedness of global economies allows us to appreciate the importance of true diversification in building a resilient investment portfolio. Diversification isn't merely about holding numerous stocks within the same asset class, as some mistakenly believe. True diversification involves strategically spreading investments across different asset classes to ensure they don't move in lockstep during times of stress. Consider the analogy of a barbell. Having 50 stocks might seem diversified, but if they all belong to the same asset class, they're essentially two ends of the same bar. During tumultuous times, they are likely to move together, amplifying risk rather than mitigating it. To safeguard your investments against unforeseen challenges, it's essential to diversify across assets like 10-year Treasury notes, real estate, and cash. The appeal of Treasury notes lies in their stability and credit security. A diversified portfolio should include them, providing a deflation hedge in times when interest rates are expected to decline. Such notes can offer not only stability but also potential capital gains. Real estate, particularly multifamily housing, residential real estate, and income-producing properties like farms, adds a layer of diversification. While commercial real estate might be premature, residential properties present a tangible asset with the potential for both income and appreciation. Now, let's talk about cash. Often dismissed for its low yield, cash plays a crucial role in portfolio resilience. In the face of deflation, cash performs remarkably well. Beyond its deflationary advantages, cash acts as a stabilizing force, reducing overall portfolio volatility. It's the ballast in your investment ship, providing stability when the seas get rough. Consider the wisdom of Warren Buffett, one of the most successful investors of our time. With over $130 billion in cash, Buffett's strategy aligns with our discussion. His substantial cash position isn't a lack of investment acumen but a strategic move to navigate the same economic landscape we're examining. It provides him with the flexibility to seize opportunities when markets falter, a lesson worth noting for individual investors. As we peer into the uncertain global economic landscape, marked by potential recessions and unprecedented challenges, the need for a diversified portfolio becomes more pronounced. It's not about predicting the future but preparing for its uncertainties. In essence, empowering investors with knowledge becomes paramount. Understanding the nuances of economic systems, the influence of the US dollar, and the true essence of diversification positions investors to make informed decisions. In a world where change is the only constant, adapting your portfolio to the shifting global financial landscape becomes not just a strategy but a necessity for financial resilience. So, take the time to assess your investments, consider the discussed strategies, and chart a course for a robust and resilient financial future. In crafting an ideal investment portfolio, it's crucial to navigate the ever-shifting economic landscape wisely. Gold emerges as a star player, serving as a reliable shield against inflation. However, caution prevails against extreme measures like selling everything for an all-in on gold. A balanced approach is the key, with around 10% dedicated to gold, a sweet spot for stability. Diversification becomes a guiding principle, spreading your investments across various asset classes. Think of it as not putting all your eggs in one basket. Private equity is a promising realm, provided you have access to good deals. This adds an extra layer of diversity to your financial repertoire. The spotlight then turns to energy stocks, with giants like BP, ExxonMobil, Shell, and Marathon taking center stage. Despite the noise around the green energy movement, a critical eye deems it a green new scam, infeasible and unsustainable. Instead, focus on the undeniable truth: we still need oil and natural gas, and the companies in these sectors are poised for success. Real estate also claims its stake in the portfolio, offering stability and potential returns. The adaptability of the portfolio shines through in uncertain times, with some assets thriving during inflation while others shine in disinflation. Winners play a crucial role, compensating for the underperformance of others. Cash isn't overlooked, it's your strategic tool, akin to a thermostat. It provides liquidity and the ability to seize opportunities during market downturns. This comprehensive approach, considering various asset classes, ensures your portfolio is resilient, adaptable, and ready to weather the storms of the financial world.